and welcome to Energy Footwear's annual review meeting. For those of you who know me, I'm Katrina Swan, Chief Operating Officer, and with me is Elizabeth Winter, CEO and President. This will be our last conference together as our company has been bought out after 20 years of making quality athletic footwear.
As Katrina mentioned, I am CEO and President of Energy Footwear. So let's start at the beginning. Our new management team came in year 11, so that's where we're going to begin today's look at the financials and the overall company of Energy Footwear. And with this, we hope that you, the investor, can get a good grasp on the past 10 years and decide if you'd like to continue being a shareholder here at Energy Footwear.
Yes. So in year 11, we started off strong. We had positive ending numbers, and we met and exceeded expectations in most categories. From the beginning of year 11, we turned the company over to new management, which had its benefits and its challenges. Our company was already established in the footwear industry, and we wanted to maintain the high quality and standards which our footwear represents.
In year 11, we were really just trying to find our footing in the industry. No pun intended. We tested out a few strategies trying to figure out which one would work the best with our new management team and the new direction that we wanted Energy Footwear to go. We decided upon having low quality, low materials so that we could give our consumers the greatest amount of ability to buy our products.
That's right. So overall, year 11 was a success. And things are looking good for our new team at Energy Footwear. Of course, every year brings with it its separate ups and downs, but we were pleased with our performance from the start.
We now have a special treat. Caralyn, our CFO, and Sean Williams, our Vice President, will now give us a more in-depth look into our financials and numbers of year 11.
As mentioned, I'm Caralyn, CFO of Energy Footwear. I'm going to go into a little bit of detail about some of our financial achievements this year. During this year, we met all of our investor expectations, which included earnings per share, return on equity, image rating, and our stock price. As you can see from this chart over here, our earnings per share was 33 cents above the investor expectations. And down here, return on equity was 3% higher than the investor expectations. And then continuation, our image rating was 5 points above the investor expectation, and then our stock price was $4.38 above the investor expectations. And these were because we had a big portion of the market share because our prices were lower than everybody else in the industry. Now our Vice President, Sean Williams, is going to talk a little bit more about our decisions we made to get to these values.
Hello friends, my name is Sean Williams and I'm the Vice President of Energy Footwear. So early on, we made an aggressive decision to expand production into Latin America. Looking back, some people might say we might have been brain dead at the time, and it certainly seems like we could have been. The reasons why we chose to do so was we thought expanding would be a good idea because we assumed that the other teams would be aggressive as well. We were completely wrong. It's just that they were aggressive in everything but expanding production.
Right after we expanded, we saw our financials drop, which are clear from these graphs. And the reason why everything dropped was because we took out a loan, but it wasn't large enough to actually cover all of our expenses. It was only large enough to cover off the building that we had bought to expand. And our EPS had dropped, so it was $1.05 when it should have been $2.85 in year 12, and then in year 13 it dropped even lower to negative $2.96 when investors wanted it at $3.05. And our ROE was 5.6 in year 12 when the investors wanted it at 15%, and then in year 13 it was negative 16.1% when it should have also been 15%. And then looking at our credit rating, we were at a C credit rating. We should have been at a B+. And then year 13 it dropped to a C- when we should have been at a B+. And then our image rating, as you can see, is 67 when it should have been 70. Year 13 dropped down to 60 when it should have been 70. And then our stock price had also dropped significantly, being 19.65 and it should have been 34.25. And then in year 13, 11.42, when it should have been 36.75. So all of those are large decreases from where they actually should have been throughout the years.
So after this minor recession, we had to come up with a fix. Despite the need to cut back expenses, we increased our number of models as well as advertising. And we also lowered the prices in the internet segment. We tried to secure a celebrity, but we're outbid. And we did target the private label sector. And unfortunately, these decisions ended up lowering our market share across all 4 regions. So I would like to go back to Katrina and Elizabeth.
Great. Thank you, Caralyn and Sean. After we hit the slumps in year 12 and 13, we managed to finally get out of the hole and worked on reestablishing ourselves in the market again. We decided in year 14 to sell our Latin America plant as we were losing too much money on it in order to keep it operating. Also, to cut more costs and to try and turn a profit, we reduced capacity in our Asia Pacific plant by 800,000 pairs of shoes. We could definitely see competition increasing during these upcoming years, so we strive to keep up with our competitors.
One of the main ways we tried to increase our appeal was we early on decided that we wanted a celebrity every year. But unfortunately, our strategy was not very successful. As you look at our charts for all the years, we were only able to secure celebrity very late in the game. So early on, we didn't have much appeal into the different markets, so we weren't selling as many shoes as we could have had we had a celebrity appeal. Our market share unfortunately steadily decreased over a couple years based on our lack of celebrity appeal, and it was something we struggled with throughout the tenure of our management at Energy Footwear.
Definitely. So as you can see, those seemingly small choices like opening a plant in Latin America or securing a bid for a celebrity really have a huge impact on the business overall. Now we'll head back over to Caralyn, who will show you the breakdown of the numbers of what happened.
And then our stock price in year 14 was also low at $7.34. In year 15, we went up to $11.42. And then our credit rating also increased by a little bit. Year 14 was at a C-, year 15 we went up to a C+.
So this sharp turnaround came in large part due to our hired consultant, the advice we got. So what we ended up doing was lowering our unnecessary expenses and ended private label production for the remainder of the years. We also lowered the number of models overall, and we beefed up advertising to create some demand. And this did result in higher market share, continuing through the last of the 10 years.
Earlier, Elizabeth had the pleasure of chatting with the president and CEO of Cunningham Consultants Limited, Mr. Kelly Cunningham. Take a look at the expert advice that he offered to us.
This is Elizabeth Winters, CEO and President of Energy Footwear, and with me today we have a special guest, Kelly Cunningham, President and CEO of Cunningham Consulting Limited. Thank you so much for being with us.
Great to be here, man.
In year 14, we weren't doing so hot, as you know, and as our investors have now seen, and we wanted to help our company grow a bit. So we hired Cunningham Consulting Limited, and he was very, very helpful in bringing our company back into the green after a very bad year 14. So I wanted to ask you, what did you notice was wrong with our company when you first came and saw our financial statements?
Well, I think the first thing is that in any business, you want to make money. okay? And the minute I sat down and looked at the screens, it was obvious to me that you were not making money, okay? And so I think the first step was review the numbers, try to figure out why you were losing money. And I started to pose questions to the team and trying to get some answers to see what your rationale and what your thinking was. And once we had some conversations, I stressed the importance of profitability, not only to business but to the game. And I said, you're in business to make money. And I tried to get that message through to the team, that had to be your number one focus. And I think from what I hear, we had some success.
So was there any one thing in particular that we thought that Energy Footwear at the time was doing particularly poorly on, that we could have done better?
I think one thing in the game and in business too, sometimes you could buy market share. And I think as I sat down, and I always look at profit margins. That's usually the first thing I looked at. And when I went through your profit margins, you were spending an enormous amount of money, expenses on marketing. You had a tremendous amount of cost. And the price point you had, you were basically losing money. So my challenge to you was that you could buy market share, but you're going to lose money doing it. So my challenge to you was, how do you become a more efficient company by cutting these expenses? That was the number one thing. You had to cut your expenses, but at the same time become profitable. And I just posed it on the table. Okay, I didn't give you the answer to that question. I said, this is the problem.
Well, that's why we hire consultants.
That's it.
To see what our problem is.
Very
to have
inexpensive consultants,
Yes.
I might add. But I proposed that problem, and I challenged your team, and I said, listen, you can't lose money, okay? How are you going to cut, where are you going to cut the expenses? How much are you going to cut? And then what are you going to do to make money? And I think once I said that, you started to come back with some good answers and good solutions. Whether it was going to be, to sell some capacity, because your market share, was going to probably come down as you cut some of these expenses. And I believe those were some of the things that you started to do. And then after you worked on the screens, I went around, looked at other class members, then came back to you, and all of a sudden, those negative profit margins all of a sudden started to be positive.
Right.
And I think you took some little steps, and then towards the end of the game, really benefited you.
And I think that's all we have for Kelly Cunningham of Cunningham Consulting Limited, who is available every semester for
right.
help
Let's
in
hope
companies
not.
for a little pro bono work.
Okay.
So this is Elizabeth Winters signing off. Back to you, Caralyn.
Thanks, Elizabeth, for that enlightening video. Now back over to you and Katrina.
So as you can all see, Mr. Kelly Cunningham's advice definitely helped us in year 16. However, through year 17 and 18 we did marginally better, but could just never do as well as we did in year 16. It's like once your numbers are so high, it's really difficult to maintain them at that level. Towards the end of our management term, we brought in another consultant who was unfortunately out of town on international business matters. However, he strongly advised us to go all out and make sure we got a celebrity endorsement.
In year 19, we finally got a celebrity. We were very excited because we had been spending lots of time attempting to gain celebrity appeal in any location. We were fortunate and were able to get a very high celebrity appeal in Latin America, which is one place that we were trying to expand more shoes in. Not so much production, but to have more people wanting to buy our product there at a lower price with high quality material. So that was really a struggle, and because of this we had to go all out, and we ended up spending $28 million to get our celebrity, which was not very good in the end.
No. So once again, in year 19, though our numbers did reach new heights, we made some tough decisions to cut the amount of shoe styles we sold, but increase the amount of shoes we were selling overall. This led to a huge leap in our return on equity, our earnings per share, and our stock price, which we all know made our investors quite happy. However, from year 19 to 20, we were once again unable to sustain such a high growth rate and failed to meet investor expectations in year 20.
As Katrina mentioned, in year 19 to 20, our values changed drastically. As you can see, our earnings per share from year 19 was at $10.10. And then in year 20, it dropped down to negative 49 cents. Then looking onto our ROE, which in year 19 we were at 43.5%, which also ranked us 18th in the world in the footwear industry. And then in year 20, it dropped drastically down to negative 2.1%. Looking at our credit rating, we also dropped significantly. In year 19, we were at an A+ credit rating, and in year 20, we dropped down to B+. Our image rating didn't drop as much, but it dropped by 1. It was 65, went down to 64. And then our stock price had also dropped. Year 19, it was $89.77. And in year 20, it dropped down to $38.70. And these drops were due to us having to pay a large amount of money on our celebrity, which wasn't thought of in the beginning.
So in the final year, we really weren't able to break away from our competition strategy-wise. Just overall, prices in the market as an average went up, and the number of models went down, which is closer to what we were trying to do, and it was all significantly. So we ended up overspending on advertising and in both segments. Because of this, we ended up in the bottom half in ranking that year. And this leads me to our subsequent exit strategy. As a management team, we decided to have a clean break from the company. We felt a successful future for all our shareholders and stakeholders would be if we put up for sale and had a strategic acquisition. We're only going to be up to sale for the top 3 teams. We feel this will give Energy Footwear much needed production capabilities, capital, connections, and a new management team that is going to be proven, should be able to take over, slide right in. We're also going to have contracts set up to where employees are guaranteed employment, and our brand will remain separate from the new company. So we feel that's going to be the best decision. And now I'd like to throw it over to Beth.
Through this experience of taking over a company after 10 years of successful business, we have learned a lot about what we should and shouldn't do as a company. One of our major things that we wish we could do again if we started over from year 11 was we really wish that we had secured a celebrity endorsement early. This really played a major role in how we did overall in the market. And I think we also undervalued the importance of analyzing market trends as well as forecasting what strategies our competition would use, which was very hurtful to us overall because we were unable to really figure out where they were going, which would have helped us a lot if we could have figured that out.
Yeah, that's true, Elizabeth. It's like you become so worried and involved in your own company that you lose track of what else is really going on out there. But all in all, we still think it was a successful business endeavor. We each learned a lot, and we definitely plan to take that knowledge with us into the future, wherever it may lead. And now it's time for Energy Footwear to move on to other business interests and have different beginnings elsewhere. We really thank you all for your continued support and loyalty, and we will see you in the future.